Welcome back. We are continuing with our Indianomics series on Indian economy in 2025. And joining me today is yet another star economist, Upasana Chachra, Chief India Economist at Morgan Stanley. Upasana, good morning. Thank you very much indeed for joining us. Well, first up, your growth forecast for next year, that is FY26, not calendar 25, but FY26, is 6.5%. Does this bake in the likely tremors we may face if there are tariff hikes in the US? How much of it is baked in? Or do you see downsides if there is an onslaught of tariffs?
Hi, Latha. Good morning, and thank you for having me. So yes, our forecast for fiscal 26 at 6.5% assumes that there will be some increase in tariffs by the incoming US administration, but those would be still country specific. So our global team, both on the econ and the policy side, the assumptions that we've used in our year ahead outlook is that there will be an increase in tariffs for China and also bilaterally for some other major countries such as Mexico or the EU. We are not assuming specific tariff hikes for India in these numbers, and also not assuming that there is a case for or an implementation of the universal tariffs as have been discussed in the past. So those are not baked in our base case. If that comes through, yes, there could be more downside to the 6.5% number.
Okay, so this is the base case. Trump can engender some downside surprises if it happens. Fine. Let me also come to the currency. And maybe I'm making an unfair question because this should beat your currency strategist. But I was a little intrigued that your currency forecast numbers don't go above 85. It is 84 for the current year average, 85 for FY26. And then it goes down. Actually, the rupee appreciates to 81 in FY27. Can you explain? Because there is a school like Goldman Sachs tells us that they expect 85.7 also in 2025.
Yes, these views are made by a currency and FX strategy team, and they do include a fair bit of what they think about how the US dollar would move. So in the near term, there would be US dollar strength, but yes, you probably will not see that too much in the rupee dollar moves or the forecast that we have in our numbers. Primarily with the view that we do think, and as a both on the econ and the strategy team, that there will be a case for the rupee to get defended and the volatility to be lower. So our view is that given that the fundamentals still remain pretty okay for the rupee and the FX reserves, and generally the trend that we've seen in the past of RBI wanting to intervene to reduce volatility, we do think that rupee will be therefore more range bound rather than depreciate at a faster pace. So that is what calls for our view in the near term.
Okay. Well, any FPI will give an arm and a leg if it's only going to be 85. But right now we are already sitting at 84.5. And there is a fear that it can, go to 85.5 also. Now let me come to the growth forecast. Even for the current year, you are expecting the growth to be 6.7%, which means you're not buying the RBI forecast for the second half. They are sitting at something like 7.3, 7.4 for the second half. You don't think that's happening?
No, so our numbers were earlier 7%, Latha. We reduced them to 6.7 in this round of year ahead outlook. But most of the cuts are concentrated in the September quarter. So, that is the key debate right now. September quarter growth and high frequency data have been showing sort of a broad-based deceleration. So we do think that September would be weak. Our numbers are going to be weaker than the 6.7 for September. We are at about 6.3, probably where consensus is also right now. For second half, we do expect a rebound, but probably not where RBI is looking at. This is what they've published as yet. So our view is that you see growth picking up in second half, but probably settling more in that 6.7, 6.8 range rather than higher than that.
Okay. Let me now come to your inflation forecasts. Your inflation forecasts are pretty benign, but for the current year, you're still expecting 4.9. That's a big jump from Reserve Bank's 4. No, Reserve Bank's 4.5 is going to get revised because obviously they were not prepared for the 6% plus in the month of October. But 4.9 would mean that inflation really is not falling off.
Yes, so I do think that the near-term hump in inflation that, RBI has also highlighted, we were all expecting, but I think one is that the level is higher than what we were expecting by probably 40, 50 basis points odd for both September and October. And then the deceleration as it sets in will therefore just take a little bit longer, given that you've seen us somewhat of an upside surprise. And it's more mathematical than anything that you will then see numbers being higher. So when I look at monthly data points, you're probably looking at November print, which would still be close to say 5.5. It will start moderating from December because of the seasonality and the winter month impact on vegetable prices, etc. But as of now, at least what we think the numbers for December, Jan could still be around the 4.8 to 5-ish levels, or probably around 4.8 rather than meaningfully lower. So I think it's a lot to do with food inflation and food inflation volatility than anything else. I think headline X vegetables or core will still be well behaved, but headline per se, due to the impact of food in the near term, will also probably remain a little elevated than what we were thinking probably 2 months back.
Okay. So at one point in time, if I remember right, Chetan was saying that he's expecting practically no rate cuts. But now you all are penciling in some rate cuts next year.
Yes, that's right. We did have a view of no rate cuts for pretty much all through this year. We have added rate cuts for next year. So as of now, we expect the first rate cut in April. We do think, by then there will be more evidence of a moderation setting in inflation. December and Feb meetings, probably with the trailing inflation numbers, will be very hard. And that's why we think the first opportunity would rather be April than before that. Just given how inflation numbers are going to be in terms of headline.
Okay. Let me come back to the growth question. Again, I'm going back to Goldman Sachs because that was the first of our series on India at 2025. The fear about growth rises on several counts next year. The fiscal deficit is going to be lower. I think even you are forecasting it lower. Plus, capex even this year may not reach the target. Capex will be even less. It's not as if private capex has picked up, gangbusters. And on top of this, you could have a global slowdown, a Chinese dumping. So what makes you confident about next year's growth? What are the positives for next year?
See, I think structurally, the story for India delivering around 6.5% growth is still something which is doable, given where probably macro balance sheet and corporate and financial sector balance sheets are. Yes, there will be fiscal consolidation, but it's unlikely to be a lot led by, expenditure compression. CapEx numbers we've already seen moderate. If we were to assume that second half picks up, will still be lower than last year. And now probably seeing, yes, but from going forward, probably you'll see CapEx numbers in terms of growth rate remaining where they are. You would see more shift in revenue expenditure in our view that would lead to the fiscal consolidation alongside pickup in revenues. And therefore the fiscal drag on growth should be lower from the fiscal consolidation bit. You will probably be seeing easing in the next year, and that should help from just the impact of monetary policy on growth, and therefore growth settling to around 6.5. I wouldn't say that growth is on an accelerating and upside trend, but more like a settling on the 6.5% normalized trend, which should be doable given where the structural parameters are for the economy.
Okay, it's almost as if it is India's natural rate of growth. Okay, very quickly then, if you can tell me what will be the upside surprise and what can be the downside surprises we should be prepared for.
On the upside, I think the key will be, as you mentioned already, on the private capex side. We are seeing some green shoots, but yes, it's not at an exuberant level. So probably external demand can come back as a bigger supporter to this overall end demand, and that can help improve the private capex cycle, which then I think leads India to a higher growth path or a growth trajectory on a more sustainable basis. On the downside, again, most of the risks would emanate from the external factors. I think at the moment, what type of trade, tariffs, immigration policies we see from the incoming US administration will be important. Again, that may still impact more of the second half of the next year in our view, because by the time it's implemented and it flows through, in terms of real economy variables, there will be some lag. But of course, markets and sentiments will start reacting much before that. But from a real economy perspective, probably second half would have more risks associated with what policies we see in the first quarter next year from US.
Oh, yes, that is the unknown, isn't it? Upasana Chachra, thank you very much indeed for joining us. So that's the key takeaway, that India will settle to its natural rate of growth of 6.5. Now, that can be a disappointment. It's not 7, which we would like it to be. But Morgan Stanley is still a little more positive than Goldman Sachs, who see it actually at 6.3. Let's see how things pan out. Thanks much for watching this special edition. After a break, Chartbusters.